Hey, this is Sasha Evdokov, and thanks for joining me here for another quick lesson about investing and stock trading. Now today, what I'd like to do is share with you the difference between calls and puts. What's the difference? If you're just getting started in option trading, you might be wondering, well, they talk about calls and they talk about puts, but what does each one mean and what can I do with it and how can it benefit me? So in this video, that's what I'm going to explain to you. So first things first, if you don't know what an option is, you need to understand the basics behind an option before understanding a call and a put. So an option is basically a contract that gives a buyer a certain right. Now, options can be bought or sold even if you don't have the merchandise, meaning even if you don't own the stock. You can still trade options. So you don't need to own something to sell an option first. It's like a dealer selling a car first before that car is even in his inventory. He's selling it to you before it's even in the showroom. And that's what they do. They sell it and then they custom make it and order it. So that's the same thing here. You can buy or sell options. Now, the beginning basic level, if you're just getting started, most people are going to be talking about buying an option, which is basically a contract that's going to be buying a call or a put. Now, you can think of options like coupons, okay? And I think that's the easiest way to think about them. Now, the general concept, as far as looking at it from a coupon standpoint, is it has the same kind of concepts like an asset relationship. So when you look at a coupon and you have a coupon like a discounted coupon where you get $1 off of McDonald's fries before July of 2018. So here, the asset relationship is the ticker symbol, okay? It's the McDonald's, the fries. What is that coupon for? It's for that one-to-one relationship. It targets specifically something. So an option has that same thing. It's either a certain company or stock, like a Procter & Gamble, an ExxonMobil, could be an Apple, a Netflix. So it has that ticker symbol. The other thing it has is an expiration date. It's good until this date, just like when you have fries at a discount. The same thing here with options. They're good for 30 days, 60 days, 90 days. Depending on when you buy or sell them, they have a certain expiration date. And that's the other thing you're watching for. They also have a value, which is a strike price. So it's like get $1 off of those fries. So here it would be that $1, right? And in this case, it would be a strike price, or spend a minimum of $30 and get $10 off. So again, there's that kind of value chain. In our case, when it comes to options, it would be the strike price, such as if Apple gets to 180, then your call or put is, valued at something. There's that strike price. And finally, you have the type of discount. Is it a percentage? Is it if you bring 4 friends in? And in our case, it would be the call or the put. So in either case, buy one, get one free. What is that type of value? What is the type of thing that's happening? And when it comes to options, it'll be either a call or a put. In the real coupon world, you may have, again, a 2 for 1, a 3 for 1, or a 3 for $10. It could be a 2 for $5, get 2 sandwiches for $5, that kind of thing. And anyways, that's just the type of good that you have. So let's look at some general option concepts. Okay, so the baseline behind options. When you purchase a call, you have the right, but not the obligation to buy the stock at the strike price. Okay, so what does this really mean? In simple terms, if you own a call, okay, if you own this contract, that's called a call contract, you can buy that stock at a cheaper rate, whatever that strike price is. If that stock explodes to $1 billion, you can still buy that stock at, let's say, $100 if that was the strike price. Meaning you could buy that stock at a cheaper rate and then sell it for $1 billion if that was the current price. Okay, so that's the extreme example, but that's basically what it allows you to do. It doesn't mean you have to do it, but it allows you to do that. The other side of this is when you look at purchasing a put, you have the right, but not the obligation to put that stock to someone else at the strike price. So let's say you own a stock, 100 shares of Apple, and you purchased a put for protection, because typically puts are insurance. So you're insuring your stock. You buy a put at, let's say, $40. Okay, so that's your strike price. So now if the stock drops to $1 a share, you can put that stock to someone else at the $40 strike price, because that is the strike price you own it at. So having a put at that certain strike price allows you to put it at a higher price than what the stock is. Again, you don't have to do that, but you can do that. Now, option traders usually don't deal with the stock, meaning I don't usually put the stock to someone else, or I don't buy the stock from a call if it works out in my favor and then go ahead and sell the stock back in the open market. You just don't do that because it's 3 times the amount of trades and it's just unnecessary. Instead, what typically happens is the contract is just worth a lot more money at the time, right? So a call contract, because it's typically, if you buy a call, you're looking for a movement to the upside. If the stock goes up, that call contract is also worth more money. On the put side, that put contract, you're looking for the stock or that equity to move down. And that means the value of your stock is less, but at least the value of your put contract is more. So it allows you to get rid of that put contract for a higher value. So as an option trader, typically they simply just sell the put or the call or the other side of the trade once that contract is more profitable. Now, one of the easiest ways to look at this is to take a look at a risk profile. If you haven't seen risk profiles before, they're really handy to look at where you make money. Now, here we're looking at a profit and loss picture. That's what a risk profile tells you, is a profit and loss picture of your option contract. So in this case, this is a call. When you buy a call, the risk profile for buying a call contract. So I'm going to point out a couple of quick things here for you. And basically, when you look at this diagram, here we have the profit at the top on the left side, and then you have the loss, anything below this 0 line. So we have this 0 line right there. Now, when you look at this black line right here, this black line is at expiration, because remember, option contracts have time value. So this whole black line really is your contract at expiration. Otherwise, you are at this pink or purple line, okay? So that is the current date and time of your option contract, the value. And with time, it slowly gets closer and closer and decays to the black line. So think of this like going into a baseball game. And when you go to a baseball game, tickets, let's say 3 months in advance, are the normal rate. As you get to the day of the game, they're a little bit cheaper because people are scalping. Once the game starts, you could probably haggle and get those tickets super cheap. And then if the game is halfway done, you might be able to pick up those games for $5, or real super cheap compared to what the normal rate is, simply because of the time decay that has happened. It's so close to expiring and the game is almost over. Now, the other thing that we have here is on the bottom is the price of the stock or ETF. So for example, if you started the point, meaning when you got this call contract and you bought it, let's say at $35 right here, okay, $35 was the stock price, and then it continues to move up with time and it gets to 40, your profit potential, how do you read it, would be right there, okay? If it continues to the $50 range, okay, so again, your profit potential would be somewhere at a little bit higher level. Now, if it actually goes down, and let's say it goes down to the $25 range, then again, you draw it, and then where's your profit potential? It would be a loss at that price point, okay? Now, keep in mind, if this happens in 4 or 5 days, that pink line would be even closer and tighter, and at expiration, you would lose that amount based on that black solid line. So the risk profile really allows you to see this big picture concept in an easier way of what's happening to your position, to your call contract. Now, if we look at a put contract, okay, buying a put, let's look at a risk profile for this. Now, it looks a little bit different because for a put, you're actually looking for stocks to go down, right? You're buying a put to insure yourself, right? To insure your stock position. So normally what you want to happen just from the put standpoint is you want that stock to head to the downside, right? And you can see that by this price movement. So you can see all your profit is actually made if that stock goes down. So here's our break even point at right around the $25 range where we hit the zero. And if the stock price actually goes up, we lose money. We'd be in this losing range, okay? But if the stock price actually goes down, we make money, right? So if it goes down to 20, we would be at a profitable range, okay? So that's actually what you want with a put contract, is you want it to go down. Now keep in mind, most people, they own a stock, right? They own stock. So when you own a stock, and let's take a look at this risk profile for owning a stock, you can see that right here, here's our risk profile picture, right? So we basically buy the stock at around $35, and when it gets to 40, well, we have a little bit of profit. When it gets to 50, we have a little bit of higher profit, right? But as we lose money and the stock price goes down to 25, we're at a loss, okay? So that's what buying a stock, the risk profile picture, looks like. Now, if we go back and you look at the put is insurance in case your stock goes down, right? So at least from the put contract, you're able to make some money from a downside move in your stock. So that way you can still hold on to your stock and make a little bit money from your puts. And that's what people do, is they basically insure their stock a little bit by buying some puts. Now, it's not a full position, but it gives you a chance to make up a little bit of that loss when that stock heads to the downside. So here's a quick little cheat sheet for you based on what we just talked about. It gives you a little bit more insight than what we discussed, but if you're basically a buyer, okay, if you're buying a call, you want things to go up, and then you can sell the call and you make money. If you're a buyer of a put, you actually want the stock price to go down. Now, if you're a seller, it actually works in reverse. Now, this is beyond the scope of this video, but you can see that being a seller of a call is similar to, okay, you want the stock price actually to go down. It's basically like being a buyer of a put. Now, there's some additional risks that go with being a seller. For example, being naked, if you just sell it without stock or ownerships and things like that, without buying protection. So you want to be a little bit more careful. But in general, if you're a seller right here and you're selling a call, you want stock prices to go down. And if you're a seller of a put, you actually want prices to go to the upside. Okay, but we'll cover more of this in detail as we get into other and future option trading videos. So by all means, take a look at my website and take a look at some of the other videos to get more detailed evaluations of this. With that being said, let's take a look at an options trading platform and see some of the differences between the risk profile pictures of buying a call and buying a put. And then I'll compare this to buying a stock and what that looks like. All right, so if we take a look here at this Think or Swim platform, in simple terms, let me just show you the risk profile side of this option trading panel. You don't have to get too detailed in the panels, just looking at risk profile pictures or profit analysis pictures. So here, if I right click Apple and I go ahead and buy this stock, and we'll just evaluate here 500 shares. Let's drop it down to 100 shares actually. Okay, so you can see I have this risk profile picture. So here the current price is right around 145.03. Okay, if I go ahead and buy this stock at this price point, what I could do is, when you look at it, if it hits 149, okay, right here, this stock, I'm actually profitable, a couple $100. Okay, if it hits a 154 around this price level, I'm profitable about $1,000. Okay, so let's look at where I would lose about $500. Well, if I go ahead and draw that loss at the $500 range, it'd probably be right around the 140. How about where would I lose $1,000? Again, let's draw it out, draw that line where it connects, be about 135. So you can see how looking at a risk profile picture really allows you to spot the profit and loss analysis really quickly. Now, in this example, we only have one single line, okay? If we go ahead and take a look at buying a call, okay? So you can see when we look at this picture, this over here are calls. How can I tell? Well, top left says calls. This on this right side are puts. How can I tell? Well, there's the big sign for puts right there. Now, in here, we also have the strike price right there and the expiration. So how many days to go is basically 31. That's indicated here on this panel and platform. If I close this out, I can actually see there's many more days here. There's a 59-day range. There's a 87-day, 122-day, 150 days contracts, and there's also those dates that correspond with that. So if I wanted a 59-day option contract saying that, okay, well, I believe that Apple stock will go to 160 in the next 60 days, I could go ahead to the call contracts there, right-click, buy a single, which is a little off screen, right-click, analyze the trade, and here you can see my 160 is the strike price right there. So there's my 160. There it is. If I draw it straight up, okay, that's my strike price that I needed to get to. Now the current price is 145. So that's exactly where I would be placed initially on my trade. But my target is 160, which is that strike price. Okay, so when you look at this profit picture, you'll notice it's basically exactly what I showed you earlier. So here we have our loss. Our max loss is $71, which is 71 cents, because on option contract, you're dealing with 100 shares, okay, or you're controlling 100 shares, so you multiply 71 cents times 100, so that's why it's $71. So that's your max loss. Now, as that stock continues to go to 160, if it happened tomorrow, you would be profitable $145. So again, what is this white line right here that we have? Well, that is current, today. The green line is at expiration. Okay, so we have that expiration graph that we talked about. So if I move the time forward, here's our theoretical time value, and I move it forward, you can see that white line gets closer to the green line. And with time, I actually lose, this is, by the way, the Greeks, the theta, I lose about $1 per day here as that stock stands still. So when buying a call, you need that stock to move, okay? So you can see it has to basically move to 160 or higher for me to get any sort of value. And you can see between the bid-ask spread, there's a little red tick mark. They need it to actually go to about 160.77, okay? Now, if I did a little bit tighter contract, let's say 150, which is very close to what it is now, it's 145. Now, I'm paying more for it, right? I'm paying $2.81, multiply it times 100, so it's $281 rather than the $71 we had before. So if the stock stands still and these option contracts expire, I lose $281. However, as it moves to, let's say, 155 or 160, I would make already $893. So you make a lot more. But again, you have that time value as time continues to move forward. You're actually losing about $4 per day on this one. Again, this is the basic concept behind options. As far as getting more detailed into it, there's a lot of more factors, but this is just a general concept. If you're looking for puts and you're looking to buy a put, let's say you're betting for the stock to go down, I could go ahead and say, okay, well, it's going to go down to 130 in the next 60 days. I could buy a single put, okay, right here. And now you can see the graph is going the other way. And both of these graphs go to pretty much unlimited. Now, with a put, of course, the unlimited factor is to 0, right? Because a stock can only go to 0. With a call, the unlimited side is, well, to infinity. You can just continue heading higher and higher. But in general, when buying a call or put, you have, to the extremes, unlimited potential. Okay, so looking at this one, again, you have, you're spending 91 cents to buy, and you can see you're buying a put contract. Since you're buying a put, you're looking for that stock to head to the downside. Here's our price of that stock. So if it gets to 120, okay, right there, you would make about $1,100, okay? Where would you make $500? Well, take a look, be right around this, about $128. Now, this also depends on your time value, right? So if it happened within, let's say, 2-3 weeks, okay, it would actually, that white line you can see gets closer and closer to the green line. So that $500 has to be a little bit more towards the 125 range. And again, if the stock just stands still, you're going to be losing money day in and day out here with the theta, and that's at a negative $1.58. So this goes along the lines of buying option contracts, and typically this is the beginner approach to trading options of buying a call or buying a put. That's not necessarily what you typically want to do, but that's the starting point of understanding the basics and fundamentals. Now, for many professionals, let me just share with you, they're looking at selling contracts and selling premium. Again, you can be a seller of options, and you can see in this case, you're making money on a day-by-day basis. So here you're making $2.44. You need that stock price to go and stay above the 130. And here I'm selling a put, which I'm looking for that stock price to go to the upside. Now, granted, you have unlimited risk in this case because I'm not hedged or protected, but this is just to give you an insight and overview of what's to come. If you go ahead and sell a call, and let's just say we sell a call at the 145 range, now, let's say 150. Now you're looking for this stock price to go down. So again, very similar to buying a put, you're looking for a downside move. But again, you have unlimited loss potential if that stock continues to head higher. So there's some trouble actually when you start getting into selling contracts, and you need to understand what you're doing. But overall, you can see the benefits behind it is that this position, the stock or option, can stand still. It can even move up a little bit or move down a big way, and you make money. Whereas if you look at it the other approach, let's say buying a put, okay, in this case and scenario, if the stock stands still, and let's say we're buying a put at 140, if this stock stands still, you lose money. If it goes up, you lose money. The only way you make money is if it goes down, and it has to go down fairly quickly. Whereas in the other scenario, you had a 2 out of 3 profit chance, right? In those situations. In this case, you're only 1 out of 3, and you need it to move in your direction. So anyways, those are some things to think about. Thanks for joining me this week for another video lesson. Now, if you want to see some of the in-depth video courses that I have about trading and investing, some of them 10 to 22 hours long, that really cover the specifics of trading, go to my website at tradersfly.com and take a look at some of those video courses and some of the free lessons that I have available that accompany those video courses. Now, if you want to join me on a live webinar where you can ask me one-on-one questions or even just see some of the stocks that I'm looking at, get on my newsletter list by clicking the button right up here. When you get there, enter your name and email address, and I'll send you those newsletters and announcements as they are released. Thanks again, and in the end, remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.